Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. This video will follow on from the February Under the Lens video that outlined the 6 major macro themes for 2025. As in previous years, we'll build on them in this LONGWave video, the investments themes that come out of the macro themes. You will need to view the video in concert with a video already made available to you of a full discussion on the subject with the folks at Thoughtful Money. We discussed the subject shown here in the hour-and-a-half Thoughtful Money video. Full supporting slide deck was also made available to you with that video. Hopefully, therefore, we can keep this video much shorter. As a reminder, the 6 2025 macro themes are shown here at the bottom, along with those from 2024 at the top. In 2024, we laid out the investment themes as shown to the right, but kept the discussions of specific instruments to the weekly newsletters and twice-weekly chart mailings, where we could give more detailed and timely analysis. We'll do the same this year, but with some changes I'll talk about in a moment. Shown here is the 2025 investment themes without the particular investment instruments. What should jump out at you immediately is a shift to a focus on multiple types of markets versus just investment instruments within the stock and bond markets. A central reason for this is because with the end of the Great Moderation and the changes underway within the fourth turning, it is going to be increasingly about which markets you are focused on and how they are impacting the other markets. I believe the Thoughtful Money video addressed this quite thoroughly. We are now in the era where never before have you needed to expect the unexpected, where you continuously need to be concerned with market intervention, unexpected regulatory and banking changes, and abrupt government policy change. If you focus solely on the equity market, as so many people do, you will be exposed to the tail on the dog, wagging away as a dog's eyes, ears, and nose are detecting danger. By the time the dog's tail stops wagging, it may be too late, and it often is. It may be helpful to think about the dog's most important sense as his nose, which detects danger in credit markets, both domestically and internationally. Those signals today are almost always international and propagate in milliseconds. Currency markets can be seen as the dog's eyes, the bond market as the dog's ears, and his brain as the mechanism for assessing the symbols of wealth. Commodities are the non-symbols, non-fiat real wealth that keeps his body alive. All are aimed at detecting danger to keep him alive. 2025 must be about investors being on top of all markets and knowing which ones to be in and how the other markets are impacting your portfolio. As a consequence, our twice-weekly chart package will be changed to include a greatly expanded coverage of the areas shown here and what we will call the Market Lab. You may have already seen this expansion underway in recent mailings. Therefore, what is important in this session is to touch on the markets we have just mentioned. As such, I want to discuss the areas outlined here, starting with the equity market, or the dog's tail, where everything seems fine right now. Market analysts are now increasingly talking about fundamentals being at historically high valuations and that we should expect total returns to fall over the next few years. This fits perfectly with our projections for the beta drought decade to be ahead, which we outlined in our 2023 thesis paper roadmap entitled A Great Stagflation. A long-term view of the S&P 500 on a monthly basis illustrates that from a technical analysis basis, we may be at an important cusp in the equity markets. We have the convergence in the upper trend lines in the top panel of a red and black channel, long-term ones, marked by the top by a dome pattern and a circled red X. The middle panel confirms this with the potential central bank monetary policy projections. Additionally, the proprietary Matassi momentum indicator aligns and confirms the upper two panels. This chart, which goes back to 2012 when quantitative easing was put in place, has tracked our expectations pretty closely with an adjustment for the COVID shock along the way. This chart, because of Thoughtful Money's technical problems, was not visible in the video, but you can hear me talking about it at length at approximately the 1 hour mark. This chart suggests that the current market lift is likely ending somewhere around 6,400 in March or April of this year. Don't invest based on that, but certainly be aware of it, remembering that the top doesn't necessarily mean a crash, but only the beginning of a change in trend. That chart was built upon our thinking in 2012, as you can see from the copyright block on the likely advancing roadmap of the predictability of monetary malpractice, which had begun earlier but was advancing even more quickly. There is little doubt to us that with the mispricing of risk and the lack of real price discovery, that we are at the stage of malinvestment, dysfunctional markets, and investor delusion. The bond markets are also cautioning us. Yields and rates are highly likely headed higher in the long term. Because of our $700 billion in unrealized bond losses in the U.S. banking sector, the Federal Reserve will be forced to take yields lower or face a U.S. national banking and commercial real estate crisis. Federal Reserve actions are likely to be executed through quantitative easing of some disguised form and yield curve control policies, not too dissimilar to what Japan had to do when their markets in the 1990s reached similar points of overvaluation and concentration. Credit markets always lead, and we don't expect it to be any different this time. Therefore, credit markets are not only an investment area, but additionally are important early warning indicators. The yield curve chart of the 10-year U.S. Treasury yield minus the Fed funds rate is something we discovered during the dot-com bubble. It warned and shielded us quite effectively during the 2008 financial crisis. Presently, on the right, you can see how it has been drawn out by COVID, but has recently arrived at the point of cautioning us again. The central panel reflects the S&P 500 and the bottom panel, the Matasi proprietary momentum indicator, which are also aligning as in the prior era of warnings. The damage in the economy and market can be expected to occur when the Fed and financial markets begin readjusting to protracted periods of an inverted yield curve. This chart of high-yield bonds, such as junk, is also another credit area to watch, as the significance of the degree of zombie corporations now operating in both the S&P 500 and Russell 2000 is an increasing problem for the Federal Reserve. In 2008, the Fed was forced into unprecedented and frankly questionable actions legally to save these players. The layoffs and fallout was felt to be just too much for the economy to handle. A breakdown here is something that the dog and professional asset managers can be counted on to react extremely quickly on. If history is any measure, then tariffs can be expected to trigger trade wars. There is an old adage that when trade stops crossing borders, then tanks start to. If not tanks, then seldom do trade wars not lead to currency wars to offset the impact of trade balances and competitive disadvantage. Expected to be no different if Trump continues with his focus on making tariffs a key focus of his administration to reshore American manufacturing. It's the only way we'll stop just simply consuming more than we produce and driving our debt higher. The U.S. dollar is also at a potential significant cusp, as marked by the red arrow. If the Fed lowers rates, then the dollar can be expected to fall, at least temporarily. Currently, the strength in the dollar has been as much about weakness in the euro. However, the yen is presenting a major concern as the possibility of China not maintaining its effective U.S. dollar peg. The U.S. dollar continues to worry many as de-dollarization, advancements in cryptocurrencies, and surging gold prices support major concerns and potential increased volatility. Commodity prices closely track changes in the U.S. dollar. A weak dollar is normally positive for commodities. Currently, the overall commodity complex is completing a corrective consolidation. If commodities are to break overhead resistance, then the next upward leg is underway. Many subsectors in the commodity complex are already breaking higher, but until the overall breakout is confirmed, we must still label the corrective consolidation as yet complete. We've kept this video short because of the detail it supports, as outlined in the hour-and-a-half Thoughtful Money video. Our 3 times a week mailers will keep you posted as the situations change. You can count on change. 2025 will be about expecting change and how well you adjust to it. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not necessarily following what has traditionally been the true and tried approaches. You need to do your reading and make sure you have a knowledgeable and well-informed professional financial advisor, if not multiple advisors. So until we talk again, may 2025 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.